Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 246th VideoCast podcast for the week ending July 4th, 2024. Happy Independence Day in the greatest country in the world. Very excited. We'll start with a couple of family updates, then we'll get right down to it. So much data. If you thought last week's podcast was incredible, and by the way, I got so many DMs and notes last week that people said that the last 2 weeks was the best ever. I would go back and watch last week's because it was kind of a synthesis of everything we've been teaching over the last 4+ years. We celebrated Independence Day a little bit early over the weekend. We had fireworks there at the course, which was amazing. That's Mimi and Annabelle, and they're getting big. It's amazing. There's Mimi right there. The fireworks were unbelievable. This, by the way, for those following my golf career, which is probably zero of you, but I enjoy it on the weekends and after markets. I was able to burn the edges. Many of you know my goal is to break 80 for the first time. I had a 38 front, 43 back, not bad, 81 from blue-black. And followed through with some decent rounds from the blacks, index at 12.8. And I will say the putter has made a huge difference. It's brought me down from a 15 to a 12.8 in 3 weeks. So kudos to LAB Golf with their long broomsticks for people like me who have no other options. More fireworks. That's lovely Caitlin and myself at the same event. Moving on. Want to thank David Lynn for having me on his podcast, The David Lynn Report. He asked the really great questions, detailed questions, challenging questions, and in 30 minutes, I was able to lay out my entire outlook, backed up by data for the second half, and it's going to be shocking for some of the new people, more nuanced for some of the existing people that have been around for a while, so we're going to tune in now.
Welcome back to the show, Thomas.
Thanks for having me, David. Always great to be here.
One of the biggest worries for the traders and investors that I've been talking to in the last week is the rise and fall of the Nvidia stock, briefly surpassing all other companies in market cap last week, and then it's retraced about 15%, I think, since its highs. It has the potential to pull down the markets. People tell me, what's your take on what's going on?
Well, it's interesting. I put out my weekly note literally on that Thursday when it was opened at 136, and I called Nvidia the new pain trade. And of course, in the first hour of trading, it went $3 against us. From 136 to 139. We have no positions in it, but we were basically saying that it's time for Nvidia to take a rest. And in the next 3 sessions, it dropped 15-16% peak to trough. I went on Fox Business with Charles Payne. I said, he's like, wow, that was a great call. And I said, yeah, now expect the technical bounce. The next day, we got like an 8% bounce. And now we seem to be rolling back over. Look, it's a great company. It's got great management. It has a great product. It will be a major player in AI. But the key thing here, David, is price is what you pay, value is what you get. And at that point in time, on that Thursday, when we put out the article, the next pain trade on hedgefundtips.com, it was trading up to 41 times sales. You're going to pay for 40 plus years of forward revenues and 51 times of earnings at that point in time with 33% earnings growth. So the other thing was you had a lot of selling. Insiders have sold more in the last few months than you've seen in history. 750 million. Jensen Huang himself sold 94 million, filed to sell up to 750 million in his 10B plan, which is a pittance relative to what he owns, but it's not nothing. So these are the factors that encouraged us to write the article. Probably time for a multi-week or multi-month breather on the Nvidia front.
And going back to my original question, if it takes a breather, like you just said, will that affect the rest of the S&P?
Okay, so this is a great question. I think what you saw in the first half of the year was interesting in the sense that 60% of the gains were driven by 5 stocks in the S&P 500. I think that's going to be flipped on its head for the second half. And that's not just hope or pray that Powell does the right thing and yada, 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 and gambling on predicting something you can't predict. What that's predicated on is earnings growth. So the outperformance of those concentrated stocks was justified by the earnings growth. For instance, in Q1 of this year, the Magnificent Seven had 50% earnings growth, and the rest of the S&P 500, the unmagnificent 493, had negative 1%. That's why you saw the outperformance of the ones that had the earnings growth. That is going to flip upside down by Q4 of this year. Magnificent Seven will be doing fine, but they're not going to grow at 50%. They're going to grow at 17%. And the unmagnificent 493 are going to grow earnings at 19%, up from negative 1% in the first quarter. So therefore, I think you're going to see a dramatic rotation away from that concentrated, crowded trade. It is the most crowded trade is long Magnificent Seven. The second most crowded trade is short China equities. We can touch on that later. And the other thing that in terms of this sea change, David, is small caps, which only will have 4% earnings growth this year compared to large caps having 12%. But next year, that accelerates to 17.7% earnings growth for small caps and only 14.2% for large caps. So we see an enormous tidal wave sea change coming in the second half and beyond.
So far, though, in the last 30 days or so, the other 8 sectors besides tech, and I think I can't remember the other one, but anyway, 8 of the 10 sectors that I've been looking at have been diverging from the S&P. They've been underperforming. They've been going down, right? Yes. Tech is the only sector that's been leading. And in fact, tech is the only sector that's outperformed the rest of the S&P 500. This divergence, is that worrying to you for seeing the weakness of the other 493 stocks that you talked about?
Yeah. So the last time, the other sector was communication services, which has a bit of overlap. The last time we saw this type of an extreme divergence of this magnitude was the second and third week of October of 2023, which is not that long ago, but most of us have short memories, many investors for sure. And basically, you had a situation where small caps were in the toilet. Anything that wasn't leading was left for dead. And you had a shift in posture from the Fed, namely that the tightening cycle was stopping. It didn't mean the easing cycle was starting, but the tightening cycle was ending. And within 2 months, you basically got 2 years of gains. Everything under the surface that had not performed into that October hole just ripped. And you had stocks up 50%, 100%, literally in 2 months. It was insane. And the divergence we're seeing right now, certainly as you pointed to, David, the last 30, 45 days is even more pronounced than that period. And I think the turn is going to be equally more pronounced, and it's going to be imminent. Now, as it relates to Nvidia cooling down or taking a breather or even moving lower, and the impact on the indices, I think if you do see underperformance in the Magnificent Seven, doesn't have to mean they crash. It doesn't have to mean that it's 1999 or 2000. It certainly is not, because in some cases the price is underpinned by earnings power and cash flow. What it does mean is they will perform less well than the general indices. Conditions are turning to favor the unmagnificent 493. So you could see a huge amount of stocks under the surface rallying, and you could see the general indices going sideways or maybe up a few percent, but nothing like the first half. And that's further supported by the point of view and the data in the first half of this year. You had a 15% return in the S&P 500 with a max drawdown of 5%, but the average stock had a max loss of 15%, and that even goes more pronounced in the NASDAQ, which was up 18%. The average stock in the NASDAQ had a max drawdown this year of 38%. And then you go to the small caps, Russell 2000, 0% gains through the first half, with the average stock having a max drawdown of 29%. So there's an enormous amount of pain and opportunity under the surface. And I think what people are worried about is if these things slow down, will the indices crash? But the fact of the matter is most of the components have been trading as if the indices are at or near lows, even though the price of the indices, supported by a small concentration of stocks, is holding up. Many of the stocks underneath are trading like the index is already in pain. And that's why I think you're going to see more of a grind rotation with a lot of money made under the surface, while people in index funds the second half are going to be like, why aren't I gaining anymore? Why is it just going sideways? And big money will be made by stock pickers.
Well, what concerns me isn't that there's a divergence in the sense that the tech sector is leading on the upside. Actually, the other 8 sectors I talked about are going down since the beginning of June. Doesn't that signal to you weakness in the broad stock markets, just taking out the Magnificent Seven tech stocks? Doesn't that signal to you that you should stay possibly on the sidelines or perhaps even short these markets?
The fundamentals on a company by company basis for the vast majority of the components I'm looking at in the 493 don't support that. And if anything, I think what you have is an issue of Fed posture. And you've got a dual mandate where you've had a tremendous amount of hawkish talk, because that's what they have in terms of forward guidance. You're not going to get dovish talk until, in retrospect, they say, here's why we cut. Not, we're going to talk dovish until we cut. There's no purpose of not cutting if you're going to talk dovish. So if you're not cutting, the only thing to do is to talk hawkish until you finally cut. And I think that will be the next sea change. Now, you see the numbers moving around this morning. We had 68, we were up to a 68% chance of 2 cuts by December. Now we're at a 61% chance of 2 cuts by December. You got a 94% chance of 1 cut by December, and like a 61 down from 68% chance of 1 cut by September. I think that is going to be a critical catalyst, because they can't ignore the dual mandate when you have initial jobless claims climbing up, you have the unemployment rate climbing up, the employment side starting to crack, and then the 2 biggest components of inflation, one of them finally cracked, which was auto insurance, which had such a heavy weighting in the measurement. That was the stickiest one, and now we're just waiting on owner's equivalent rent, which has a significant lag. So I think that they're at a crossroads here, and the rest of the developed worlds have figured that out. Switzerland's already cut twice, ECB's cut, Sweden's cut, Canada's cut. We're in a global, I would say easing cycle, but they would say removal of restriction cycle, which I guess is fair when you're 200 bips above inflation in terms of restriction. And I think there's going to be more of that to come. And I think that effectively any company that all the dividend yielders are in the tank because on the basis of cost of capital, anything that has any leverage on their balance sheets are in the tank. So if you get 1 or 2 cuts, I think it's a mid-cycle thing, and that's all they'll have to do if they do it soon enough. If they dither and they fumble and they wait till after, the end of the year, chances are they're going to need 4, 6, 8 cuts, and then we got a problem. I don't see it going in that direction, because central bank policy is coordinated on a global basis, and the rest of the developed world has already moved, in addition to the Fed, which is back in the market, replacing $35 billion a month as of January 1st, as it relates to Treasury bond purchases.
That's an excellent point. In what way are they coordinated? Because, like you said, the Bank of Canada has cut rates. The Bank of the ECB has cut rates, and now the Fed is not. Right. And I've been getting the feedback that the Fed is looking at domestic data only, but you're saying that it's only a matter of time before they catch up with their peers. Why is that?
Yeah. So during the tightening cycle, when we printed increased money supply by $6 trillion, and then we had to tighten, and the West had to aggressively tighten in a coordinated fashion. Bank of Japan became the global liquidity provider. So they kept easy policy. They not only were buying JGBs, they were buying global sovereign debt from around the world, including US treasuries. And then they went even further out on the risk curve. So they were buying Japanese equities, and they were buying global equities through ETFs. That has now played out almost completely. And I say almost completely because the yen is trading at lows, multi-decade lows relative to the US dollar. They will be intervening this month. They've said as much. It was surprising to the markets that they delayed last month, which is part of what you're seeing in terms of these extremes that you referenced earlier. They are going to defend the yen. And they are going to be tightening. If you look at their inflation numbers, tightening is warranted. So they are going to be now completely flipped from being the global liquidity provider to being the only developed central bank that's moving into a restrictive period. As they move into restriction, it should give the Fed the runway to begin some modest, I would say, easing. They will say removal of 200 basis points of excess restriction. Call it tomato. It's the same thing. And they'll be, I think they're going to have cover to do it in September and at the very least by December 1. And they may be able to do one to two and done if they get it early enough.
Some people say that the Fed is late to cut, but could we take the view that the other central banks are too early? Let's just take the Bank of Canada, for example. We don't have to talk in depth about the Canadian economy, but the Canadian inflation rate is now at 2.9%, unexpectedly jumped up from 2.7 just a month ago, right? So why is it that the other central banks are cutting before their 2% inflation target has been reached?
Because 2% is an absolute fantasy, and they're never going to verbalize the fact that the new target is 3%. The fact of the matter is the West has taken on too much debt, too many deficits, and the only way to get rid of those debt and deficits is to actually inflate it away. So that's exactly what happened from 1948 to 1956. We got debt to GDP to over 120% like we have it right now. We borrowed a massive amount of money to fight a visible enemy at that time. This time we borrowed a massive amount of money to fight a quote unquote invisible enemy, and then excessive spending on top of that. And the only way any government's ever quote unquote paid anything back is in devalued dollars. They will have to run inflation above trend as we did from 1948 to 1956. 3% is the right number. If you look back at history, that's what they did. And within about 8 years, they lowered debt to GDP from 120% down to 63% just by running inflation a little bit above trend during that period. I think we're set up for a similar situation, and that's also underpinned by the demographic demand and growth prospects of 72 millennials at age 33, 34, starting housing, family formation, and demand for capital. So all the things are aligning together, and they'll continue to talk to, but at some point, like Canada, like some of the others, they're going to have to go a little bit early, even if it's only 1 or 2 will be sufficient. And to the extent that we need liquidity removal, Bank of Japan will have to step in on a global basis, which they're now incented to do with the yen at nearing historic low levels.
Okay, that's a key point. If it's indeed true that 2% is a fantasy even for the U.S., are you saying, Thomas, that the Fed is likely to cut before the core PCE gets down to 2%? I think it's at 2.6 now.
100%. I mean, nothing in life is 100%. I'd say 99%. I'd say if you take that bet 1,000 times, 999 times, you're going to be right. Maybe this will be the 1 in 1,000 where you're wrong, but I'd take that bet over and over.
I mean, you've been pretty right so far, at least if you, at least on my program, if you go back out for the viewers, check out Thomas and I's previous interviews. He's made a number of correct calls, including the market, which we'll end on in just a bit. But the Fed has made it pretty clear that 2% is the target. If they flip-flop on this, if they do what you're saying, that's going to make them lose credibility. They don't want to do that, right?
Look, they already have no credibility, right? I mean, they started way too late. They said there was no inflation. They were buying bonds when it was evident that there was already inflation. So no one has any fantasies about them having credibility. It's a question of when they're going to do what's in their own interest. And history says they're going to do it too late. And the other central banks that they've coordinated with throughout the whole COVID process are doing it on time. So I think they'll be the next to follow suit. The fantasy comparison about Arthur Burns and everything else, the conditions were so abjectly dissimilar between that 1970s period and right now from a demographic standpoint. The fact that Arthur Burns' name even comes up in the same sentence as Powell's is mind-boggling to me, and he read the wrong history book. What he should have read is the history book of Alan Greenspan pulling off the perfect soft landing in 1995 to 1996 by acting on time and acting in the right way with 1 to 2 quick cuts and then off to the races.
You mentioned this rising debt. Now, the CBO, Congressional Budget Office, has projected that the deficit will continue to widen into the next decade or so. How does this play out from an investment standpoint? Does a rising debt and deficit levels impact your strategic outlook and positioning at all as a fund manager?
I wouldn't make that same bet. I think that debt to GDP is going to come down. I think inflation is going to, look, the problem we had for 10 years is we couldn't get inflation to come up. And that's a much bigger problem than getting inflation to go down. We know how to get inflation to go down. If we want to tank the economy, if we want to cause defaults, we just keep it restrictive for an excessive amount of time, and you will get inflation down. Deflation, on the other hand, if they dither here, you could wind up in a Japanese type situation, and deflation can be hard to kill for decades if you don't get at it aggressively and quickly. And if you look at 55 some odd percent of inflation components coming down to pre-pandemic levels, below pre-pandemic levels, you would say that and they've acknowledged the two-sided risks are starting to weigh in the favor of deflation. Now, back half of the year, there's some rumblings about freight costs is going to be an issue. But if you deconstruct the components and the weightings, I think that the number one thing that we just have to keep our eyes on is insurance continues to come down. And then finally, we get a little breather on owner's equivalent rent, which I think is going to prove to be the case as we look at all the rental data from around the country.
All this data indicating perhaps a slowdown in inflation, slowdown in economic activity, does it indicate to you a hard landing at all?
I don't think so. Because I do see, we basically moved from a destocking cycle. In other words, a lot of the components of the unmagnificent 493 over-ordered during COVID because they couldn't get any supply. Then they spent effectively 7 to 8 quarters from 2001 to 2003 destocking, which impaired their earnings power. And that's now inflecting where the unmagnificent 493 are going through their trough destocking cycle, which for most companies ended like the fourth quarter of 2023, to the restocking cycle, which is why on a lag basis that earnings power comes back to the back half of the year. And I think that maybe there was some pull forward in the Magnificent Seven, but I think it will be offset by the unmagnificent 493 into the restocking cycle, which historically lasts multiple years. So a lot of these cyclical companies are going to do much better than people anticipate. And even if you think in the scheme of the overall market, David, this year you've got 11.1% earnings growth for the S&P 500. Next year you've got 14.19%, and you got a 21 times multiple, which people say is rich, except for the fact that over the last 24 years, the average earnings growth has been about 6 to 7% compounded with a 17.6 times multiple. So you could say that, we've got a peg of 1.47 if we look out for forward compared to what we'd had historically of 2.81, peg meaning price to earnings growth. Most of it, people think about that in relation to an individual company. But if you think about it in relation to the indices, based on the earnings growth coming out of that destocking cycle into the restocking cycle and the cyclical starting to get earnings power in the back half and in 2025, there may be space based on earnings growth for more multiple expansion without becoming excessively expensive relative to growth. I'm not making some fantasy bull case because I want to be bullish. I'm just saying that, I'm perfectly comfortable with the idea we could get a pullback and certainly going to see some volatility before the election. But I think overall, the underpinnings for the 493 and small caps and everything that hasn't worked are so strong right now, with maybe a little Fed catalyst, with certainly an earnings catalyst, with certainly the business cycle turning in their favor and against what's Led's favor. Everything points to generally okay. Now, is this the time to go out and buy an index ETF hand over fist? No, I think you're not going to be super happy or excited about what happens in the next 6 to 9 months from just an index perspective. But if you look at those groups that have been out of favor, I think you can make obscene amounts of money, like many people did from October of 2023 to the first quarter of this year. It was, 2 years of gains in 2 months.
Okay. That's one area of opportunity. Let's finish off on something you said earlier in the beginning of the interview, the short China trade. I'm just going to read you a paragraph from Time magazine, and perhaps we can comment on this. China is in the midst of a profound economic crisis. They write growth rates are flagging as an unsustainable mountain of debt piles up. China's debt to GDP reached 288% in 2023. That's a record. And it talks about how they've been borrowing on assets that don't generate a yield. This is especially true in the housing sector, which says this article, where sales have fallen by a third since pre-pandemic peaks, and new construction is down 60%. This is one of the worst housing crashes in the world over the last 3 decades. What's going on there? How does this translate to trading?
Yeah, I mean, that's exactly what they've had. I mean, if you look at China tech, for instance, it looks exactly like the NASDAQ in 2001 to 2003. In China, it was 2021 to 2023, down, in the case of China, 80 something percent. In the case of the NASDAQ, was down 90%. But if you were a buyer of quality tech in 2001, 2002, you made a fortune over the next few years. I think it'll be similar in China. Look, the fact of the matter is, you had all these high quality Chinese tech companies trading at 30 times. 2 years ago, they're now trading at 8 times. And the cash flows have recovered. The revenues have recovered for the most part. The earnings have recovered. So basically, you have a D-rating of about 66% in terms of the multiple, which is abnormally, below the mean. Certainly 2 years ago was somewhat above the mean. And you have re-accelerating earnings growth. You have the government now focused on consumption, and an enormous meeting coming July 15th to 18th called the third plenary, or whatever the CCP wants to call it. It's quote unquote a big deal, and it deals with all economic policy, and all the data that you referenced are the core subjects of that meeting. And they know they have to do something, because look, at the end of the day, they still have 20, 30% youth unemployment. Last thing you want is a bunch of angry, well-educated young people on the streets, pissed off that they can't find jobs, especially, if you think about a politician's number one job is to keep their own job, and you don't want that to persist. So they've been taking these Band-Aid measures. They haven't done a bazooka yet. They've done some mini bazookas that are taking some effect, but I think we're going to probably see a material change mid-month, and that will hopefully start to re-rate some of these stocks. People will start to pay attention again to the earnings power and being able to buy, like, in the case of some of these companies, Alibaba is for instance, it's been dead money for a year and a half. It's been moving sideways, building a base like it did in 2016 to 18, and it did from in 2014. And then they take off on these parabolic moves. It's the cheapest AI play in the world, and some smart investors are getting ahead of the sea change, like David Tepper, number one position in his portfolio, almost $1 billion of his own money, and others like we have a big position. It's been sitting there. It's been doing nothing for over a year and a half, but I think we're ready, and I think this thing's going to move.
This is my final question. This article states that many Western pundits and politicians view this crisis as a sign of bankruptcy on the part of Chinese communist leadership, but it is more akin to the cyclical debt crises that have plagued capitalist countries throughout history. An apt comparison is Japan's crisis of 1989, which ended decades of high growth and rising asset prices. So, two-part question. First, do you agree that this is the result of just a debt cyclicality issue, or and number two, could this happen to the U.S.?
Look, anything is possible. I think it's unquestionable that the Chinese government, to some extent, has mismanaged things. But then if you look at their GDP growth over the last 4 decades, there's been nothing like it in terms of compound annual growth rate. So, I think when you step back and zoom out and look at the big picture, the fact of the matter is the U.S. has the largest portion of their population, age 33, 34. It's going to drive growth. The growth is going to take care of a lot of the fiscal mismanagement. And in China, believe it or not, they have a very similar setup. They've got the bulk of their population, a large swath of their population, about a year and a half older than the US, but still the bulk. So that's why our view has been, this is like 85 to 89 in Japan, where you are going to have the final blow off, the largest amount of growth in the shortest period of time in China, despite the mismanagement, because of the pure numbers and the age of those numbers. And then I think China, after a 3 to 5 year parabolic move, goes into a multi-decade age of the abyss, like Japan did from 89 until recently. So, for all the China bears, we see your point of view. We think you're 5 years early, just based on demographics and how those work. And as far as the U.S., I think brighter times ahead, certainly because of those 72 million millennials and the demand that they drive from the spending and demand they drive from age 33 to 40, puts us well into the 2030s before we could start to get meaningfully concerned.
Thank you very much, Thomas. Where can we learn more about you and find your work?
Sure. We have a blog called hedgefundtips.com. We publish a weekly podcast called Hedge Fund Tips with Tom Hayes. You can just put it into YouTube or anywhere you get your podcasts. It's one toggles between number 1 to 3 in the hedge fund category for all podcasts, and or reach out to us directly at hedgefundtips.com, on Twitter at hedgefundtips. Same thing on Instagram at official hedge fund tips, and on TikTok at official hedge fund tips. So anywhere you can find us, we're happy to connect.
We'll put those links in the description down below, so make sure to check out Hedge Fund Tips over there and follow Thomas. Thank you very much, Thomas, for your time today. We'll speak again soon.
Appreciate it, David.
Thank you for watching. Don't forget to like and subscribe.
And we're back. So that's the overview. Now we want to get to some of the data here after the quote of the week. In case you forgot, whether we're talking about socks or stocks, I like buying quality merchandise when it's marked down. There's Warren Buffett, the greatest GOAT of all time for sure. We're going to start with data today, then we'll do the articles afterwards. We've got quite a bit of data points I want to get through here. As you see here, durable goods orders for motor vehicles and parts increased this month, which is positive. Initial jobless claims are climbing up. That starts to make the case for the Fed to cut sooner than people are expecting. And there's a lot of data we're going to talk here, continuing claims. And they actually laid the framework this week when they were talking in Sintra, Portugal, which I had the pleasure to go to last October. Many of you remember, and not only were Powell and the like and Lagarde kind of opening the door to the idea that higher for longer is untenable with the amount of debt servicing, but the Brazilian central banker really went after the West and said, you guys do not understand the illiquidity that's coming your way if you keep at this. This is a luxury that you can't afford with the amount of debt that you have and the amount of debt service. So a lot came out of that meeting. Continuing claims moving up. This is the cover the Fed needs. And you can see here, continuing jobless claims, 2024 versus the average of 2018, 19, 22, and 23. And you can see it's going straight up. This is what the Fed wants to see, to have confidence that they can move even before it hits their quote unquote target, which we addressed with David. Core PCE price index came down to 2.6, down from 2.8. This is sliding off a cliff. They're not going to get to 2 before they have to do their first cut. They're close enough for government work. It's time to get on with it. Government budget deficits under Biden and Trump, highest since FDR. FDR ran a negative 12.12. Trump negative 6.6. Biden negative 7.5. So that's a factor. And Asian currencies approaching multi-decade lows. These are the time periods when you get inflections, and we're going to talk a little bit about Bank of Japan, them intervening this month, and what the PBOC is doing in China with bonds, what you see right before massive inflection points. 2018 to 2019 trade war caused big increase in duties, but it kind of, what they're trying to say here is it pales in comparison to the escalation we saw. This was the roaring 20s coming off a low, and the duties really went up during the 1920s to 1930. This could be a similar situation where tariffs go up, but the global economy booms in the interim, partially because of demographics, partially because of other factors, and ultimately crescendoing, maybe 10 years out, 8 to 10 years out in an untenable position, like we saw in 1930. I'm not predicting a depression or anything like that 10 years out. I think we're going to dance while the music is playing, and we think the music's going to play for quite a few years before we have any of these type of worries, but it's something to keep an eye on. Dividend yield remains inexpensive versus history. Again, going back to 2002 levels, we continue to cover that. I hope you continue to take note. Growth versus value, expensive on book value. All-time expensive. The last time, again, you saw this type of stretching was 2001, and that's when if you bought small caps and you bought emerging markets, you made a fortune over the next 5 years. We think the setup is similar. Growth versus value, expensive on trailing EPS, similar again back to 2021. Growth versus value, elevated on a PE to growth, which is a PEG ratio, which we talked about with David, and growth versus value elevated on a price to sales. So all of these things pointing to what we're positioned for in the second half. Value dispersion remains historically high. Lots of alpha. Value versus growth remains well below its historic average. 2 standard deviations below, to be exact. And again, you have not seen this since 2001. As a matter of fact, there were covers in 1999 and 2000 saying, has Warren Buffett lost his touch? And while everyone was buying Cisco and .com this and .com that and AOL and all this nonsense that blew up, and even Amazon, by the way, which completely blew up, down 95% in the first 2 years after that, Buffett was buying, Coca-Cola, he was buying industrials, boring value stocks. And guess what? When the NASDAQ crashed, and even the S&P, NASDAQ crashed like 90%, S&P I think 50%, his names actually went up. And I think that we're going to be in a similar situation. I don't think tech is going to crash. I do think it's going to underperform. And I think a lot of these laggard, the unmagnificent 493, by the way, I invented that. So when you start to hear it in 3 months and everyone talking about it, you know where it started. You're going to see the 493 start to dramatically outperform, and Buffett made fortunes from 2000 to 2007 on that basis. Factor valuations, forward PE versus momentum remains near historic lows. Look, all I can tell you, ladies and gentlemen, at these periods where they're at extremes is the most painful to take the other side. And it's what creates the most amount of money, which is why you can't have leverage, because these things can sometimes tick a little longer, a few months longer, a little bit more volatility. And if you're not on leverage and you understand what you own, you don't get shaked out by short-term P&L. You focus on outperformance over a reasonable amount of time. And when these things turn, you make years and years worth of gains in weeks and months. And that's what we're after. So crowded positions in growth stocks still evident based on factors. Again, these were times you wanted to be buying value and making fortunes. Remember in 2000, 2020, those of you who are with us, we had a shoot the lights out year. And why? Because we were buying banks and we were buying energy in the hole when no one wanted them. That's when this got to an extreme, like we're seeing now, when everyone was puking out value, thinking that the cycle would never turn back up again. They were pessimistic. The world was shut down. And what do you know? Boom. Same thing in 13, 14, and going all the way back. High yield, high forward EPS yield remains underowned. Low price to book value is underowned by fund managers. This story continues to repeat, ladies and gentlemen. Sectors outperformance, hit rate around the first Fed cut. So going into the cut, you basically have comm services and outperforming. And then after the cut, if you look 6 or 12 months out, that's when REITs come back. This has been a bad year for REITs. REITs are one of the best performers after the first cut, looking out 6 and 12 months. What else? Materials, no one wants them. Here is interesting. Tech, they say, is as well, but tech has kind of outperformed into it. We'll see how that plays out. S&P 500 increasingly top heavy, market cap of the 10 largest S&P companies as a percent of total S&P market cap, 35%. You got to 25% in 2000. Now, people will tell you, well, that's because they also have that percentage of earnings power, and that has been true looking in the rearview mirror. But prospectively, what have we been talking about? The unmagnificent 493 earnings power is going to start to outstrip the magnificent 7 earnings power in the second half and beyond, and that's when you're going to see this flip on its head. Equity sentiment was unchanged in June, so it's not yet at its extreme bullishness. Great financial crisis pushed stock allocations below the traditional 60 to 65% band. What does that mean in English? People are still dramatically underweight equities since the great financial crisis. They got to 71% in 2000, and they're down to 56% right now. So there is room for acceleration. Core PCE price index month on month came in at 0.1%, in line with expectations. Here's the Asian currencies we talked about. You wanted to be a buyer of Chinese equities at this low in 2009, at this low in 2016, at this low in 2020, and we're back at that low here in 2024. And that's why no leverage. Why? Because sometimes it bounces around. Here it's gone, it's taken, we're at 2 years of a base, which was the same thing going into 2020, which was the same thing going into 2016, which was similar in 2008. So patience, Danielson. Fed's favorite inflation gauge slows, supporting case for cut. That's a headline from this week. Very good to see. June surge in the Chicago PMI returns to a normal level. PMI manufacturing started to come back from the 2-year recession, the recession that everyone had been waiting for. It was already in the rearview mirror, starting with manufacturing in 2022. We had 2 consecutive quarters of negative GDP growth. 10-year government yield changes between the end of May and the end of June. Switzerland, 2 cuts. Theirs is down 35 bips. Sweden, 1 cut. Germany, because the ECB cut. UK went down. Even the US came down about 10-15 bips. Australia, Japan, just about flatline, and Italy and France bond yields went up. Okay, now as far as S&P seasonality index, this is through all years. We're going to cover election years in just a bit. Through all years, this is June, July, August. It tends to be very strong in the first couple of weeks in July. Indices do well. Then they flatten out and go sideways through August. And then you get that September, October volatility. And this year, it'll probably be very choppy before the election. And then you get the year-end rally. Now, we're going to talk about election years in just a minute. China manufacturing PMI reaccelerating back into expansion in 51. And just so you know, through all the research I read all week, I put these in a file, and I think it enables us to go through them much faster and get you more data in a lower amount of time. And I think this is going to be a good format moving forward. This I want to make bigger. I don't know why it made it smaller on me, but there we go. So you guys can see them better. I know a lot of you put it up on your big screens. And okay, on pace for record low number of stocks beating the S&P 500. So when did we have this type of situation? Previously, not since 2000. Again, what did you buy there to make a fortune over the next few years? you bought small caps and you bought emerging markets. We're in the same exact situation right now. What didn't you want to be overweight? Tech. Seth Golden, small caps are the cheapest they've been since .com. We've already covered that. EPS is forecast to explode higher in Q2 after 5 quarters of declining EPS. Do you think they'll remain this inexpensive on an absolute and relative basis? No, we agree. Weighting of the top 5 holdings, again, we've covered that. So we did top 10. Now we're doing top 5, 27%. In 2000, it was 16.8. In 1983, it was 17.4. So again, this is an extreme. You don't really want to be on the side of an extreme boat. This is looking at Nike drawdowns since the last 30 years. We haven't had this big of a drawdown in Nike since the tech wreck in 2000, and going back before that, the mid 80s. 56% drawdown in Nike. So that's one worth starting to take a look at. U.S. airline travelers, again, up to 3 million. Pre-pandemic was 2.5 million, off the charts, off the hizzle for shizzle. Moving on, household debt service as a percentage of disposable income still at record lows, multi-decade lows. 9.8% of disposable income for U.S. household debt service versus pre-Great Financial Crisis, it got up to 13.2%. That's a big difference. What's been happening with the global central banks? I've been talking about the coordinated easing policy around the world. Well, let's take a look. You've had all of these countries cut. Brazil cut, Mexico cut, Colombia cut, Peru cut, Poland, China cut, Czech Republic cut, Canada cut, Chile cut, Denmark cut, Eurozone cut, Sweden cut, Switzerland cut, Argentina cut. So who's hiking? Japan's hiking, Turkey, Taiwan, Australia. But that was back in 2023. So they're just saying what was their last move. And the U.S. last move was a hike. So this is going to start to turn more and more green as we move forward, with the exception of Japan, which is going to be hiking, removing liquidity while the West increases liquidity. Fed funds rate versus core PCE inflation. Fed funds rate has to come down sooner or later with core PCE, as it does historically. You can see with that chart. Core CPI year-on-year change, it's falling off a cliff. You can see here. Breadth of manufacturing PMIs in expansion has rebounded from 25% in September 2023 to 53% now. So this is a big deal that we've got 53% of countries back in a manufacturing expansion, down from a low of 25% just about, 9 months ago, give or take. What is it, 10 months ago, you had only 25% with growing PMIs, expansionary PMIs above 50. Now you've got 53%, and this is going up. So when does this type of thing happen? That's all that we want to know, ladies and gentlemen. We don't care about data to be geeks. We care about data so we can buy stocks and make a ton of money. That's it. That's the only reason we're here. Other than that, we should just go play golf. I mean, really. So the name of the game is, this happened in when? 2002, that you got the manufacturing expansion. 2001, 2009, back half. This is a recovery. So you might get a slow in tech and a recovering in the unmagnificent manufacturers that drive real growth, which is symptomatic of the people at the lower economic strata outperforming like they did in the previous administration. You can see here from at this level. So I would right up here, 2016, 17, 18, that was a period when the people at the lower end really started out to outperform the people at the higher end in terms of real wages, and then it collapsed with COVID, et cetera. Global trade dynamics appear to be stabilizing. Exports are on the rise, so that's good. Remember, exports ground to a halt out of Asia. That's coming back. Internet advertising indicator suggests a stable digital advertising market. So this peaked in 2021 with the tech index, and then tech crashed, spending crashed, and now it's starting to recover, and that's a positive sign. Looks a lot like 2012 and 2003, and that was good for multi-year bulls. Disinflation in full swing. Again, more than 50% of 74 US CPI components are running below 2% year on year for the first time since 2020. This is a big deal, ladies and gentlemen. More than 50% of the 74 US CPI components are running below 2% year on year for the first time since 2020. Big deal. Widening breadth of disinflation now in services as well. That's a big deal. Northeast had an outside contribution to owner's equivalent rent. We're going to break down owner's equivalent rent in just a little bit because that's the last component holding inflation so high because of the weighting. Auto insurance went negative last reading, which helped bring inflation down. I know my insurance buddy are sending me articles that it's going back up, etc. And I think that's true for certain states. I think in aggregate, it's coming down. And you're seeing a huge trend of people self-insuring, not in the case of autos, but certainly in the case of property and casualty. And I think that could continue if not a happy medium is met. 80% of global central banks are expected to be in easing mode by the end of 2024 versus only 10% in July of 2023. When do you see that, ladies and gentlemen? 2009. Was 2009 a great time to buy stocks? It was a generational buy opportunity, ladies and gentlemen. How about 2001? I keep saying 2001. My tongue is getting tired of saying 2001. So I hope you're listening, ladies and gentlemen. And the beauty of this is, what did we buy from 2001 to 2007 to make all the money? Is emerging markets, China, and small cap value outperformed. We're getting there, ladies and gentlemen. And when it happens all at once. Job openings, 3-month averages, JOLTS. This is another number that the Fed wants to see. Ratio of job openings. By the way, I don't think there's anything else out there on markets that gives you more amounts of data that's usable in a shorter amount of time that I've seen. So if you guys can find anything, DM me and we'll integrate it. But unbelievable. Ratio of job openings to unemployed workers. Absolutely rolling over. This is the back to pre-pandemic levels. This is the stuff that the Fed wants to see. ISM manufacturing inventories, they got a little weaker recently, but they're moving back up in the right trend. And my favorite chart, ladies and gentlemen, the current inventory destocking cycle has been the sharpest in recent history. So where are we? We are exactly at the type of lows we saw when? In 2001, 2002, 2009, 2010. Did you want to be a buyer of stocks or a seller? You wanted to be a generational buyer. Destocking part was painful. Restocking part was plentiful. ISM manufacturing new orders turning back up. This is called restocking, ladies and gentlemen. Global UK manufacturing PMI. UK is coming out of hell and into purgatory and soon will be in heaven. Eurozone manufacturing PMI, even that's starting to turn. Slump in hedging. Hang Seng China Enterprise Index options open interest plunges, meaning that people have stopped hedging out. There's no sellers left, ladies and gentlemen, and that's exactly where I want to be for those companies. As in the late 90s, tech stocks have raced ahead of their earnings. So you're seeing here share of MSCI USA market capitalization, again, tech 30% back to 2000-2001 period. US high yield bond refinancing volume is starting to re-accelerate. This is a multi-year cycle on balance. The last one we had was from 2000. It started in late 2018, early 2019 off the mat and went for 2 straight years to 2021. We started in 2023 when CPS got refinanced out to 2027. And this is going to continue for another year, year and a half, especially now that rates are coming down. All of these companies that have leverage on their balance sheet that are trading like death, most of them are going to get refinanced and be off to the races. We just need to see that one cut and make sure Powell is not a moron and doesn't wait too long. Again, he keeps reading the book about Arthur Burns. He needs to start reading the book about Alan Greenspan, sticking the perfect soft landing mid-cycle 95, 96, 1-2 cuts and done. Do them early, get them over with, and off to the races. And I think that the pressure is bearing for them to do the right thing, and we'll see it. I think most likely in September. There is a lot of chatter around July. I think that's wishful thinking, but I wouldn't be opposed to it. And certainly by December. So we've got another couple years, year and a half of this high yield refinancing. Institutional loan activity is picking back up. This is what we want to see: repricing, extension, refinancings. 80% of global central banks are expected to be in easing mode by the end of 2024. We covered synchronized rate cuts are unfolding. Remember, global coordinated easing. I've been saying this over and over. 78% of banks will be cutting by Q4, along with the Fed, the highest since 1985. Did you want to own stocks in 85 for the next couple of years? You betcha. So, attribution to the 15% first half returns for the S&P 500 index. What this basically says is 66% was 1, 2, 3, 4, 5, 6, 7 stocks. So, you know, that is what it is. That's going to flip on its head. Earnings growth per share. This chart points to why you don't want to get too aggressively bearish, because earnings growth is going to really hockey stick up in the next few quarters, starting with this earnings season. That doesn't preclude, you know, seasonal and election year volatility in September, October. But to get too bearish too early, I think will cost you. I think we got a little juice here. ADP national employment report, payrolls, you can see that's going down. That's good for the Fed. Same thing with the U.S. Economic Surprise Index. This is going back to levels in 2018 and 2014, these short-term blips. That also helps the Fed make its case. And here is the seasonality of both all election years. I think this is Carson Group or Fundstrat, one or the other, both great shops. All election years since 1950, and then election years after having up 10% since 1950, 13 times. So basically, we are in an election year where the first half was up greater than 10%, which means this you basically get some early July strength, then flattish, then a little bit of dip in the end of July, which a lot of people will go short and flip out. But then you actually get a strong August in election year, which is really strange, and then sideways chop through from the end of August all the way through the election, and then straight up once you get some clarification on the election. And then regular election years, if it wasn't up, you get a little more downtrend in October before the election. But I think we could see this orange type of situation here. Total return index, for those of you who think owning the dollar, gold, T-bills, or bonds is a good idea, if you put $1 in any of those versus stocks since 1802, $1 turned into $2 million over the last 224 years, or 222 because it starts in 1982. So $1 became $2 million and change. If you did it in bonds, $1 became 1,800. If you did it in T-bills, $1 became 233. If you did it in gold, $1 became $3.92 after 224 years. And if you put it in the dollar, your dollar became 3 cents. So those of you sitting on cash, to be safe, think again, stocks is the name of the game, and that's why we spend an hour to two each week going through our best ideas. Alternative general data generally indicate lackluster hiring in June. This points to a very important number tomorrow. If tomorrow is a huge surprise to the downside, July gets back on the table as a live meeting. I'm not betting on it, but I would not be opposed to it. Let's just put it bluntly. So tomorrow morning is big. No golf rounds tomorrow morning. That's for damn sure. This is a big report tomorrow morning that we want to pay attention to. Consensus is 190,000. If it comes in less, like the ADP is talking about, and others, or materially less, and if unemployment ticks up from 4 to 4.1, 4.2, then the Fed can go. I mean, there's no reason to hold them back other than stupidity if we get a weak number tomorrow. Earnings continue to hang in there, 278 for next year, 244 for this year. Disposable income is outpacing inflation, so that's positive for the U.S. consumer. Auto sales were up slightly, but a little bit weak in June, and there were a couple of factors for this. Number one, you had that CDK outage with the software, so all the dealers had to do sales by hand, and they couldn't get their financing synced up to the computer things, and yet it was still much stronger than 2022, a little lighter than 2023, but we're going to take a look at the longer term number, and you'll see this is a range that we can continue to accelerate for Cooper Standard at these levels. And if we get some more positivity, then it's going to even get better. Job openings back to pre-pandemic levels, job quits levels, telling the same story. And Lagarde finally said what I've been telling you about the Fed's 2% fantasy. Lagarde now knows that it's a fantasy, and she says ECB doesn't need services inflation at 2%, and she's already been cutting. Periods of extreme market concentration during the past century. So look, guys, it hasn't been this concentrated since the late 20s, and it wasn't even this concentrated. So again, if you want to be in those 5 or 10 stocks, have at it. We're in 2 of them. We may even consider it lightening up on some of them. But I wouldn't want to be as concentrated as most people are. And I'm not going to say the N word as it relates to the stock that everyone is crowded into right now. But, the only thing they have going for them right now is Pelosi just bought a bunch of call options on it, but which was a rally before the holiday. But we'll see if that's sustainable. Okay, so concentration risks. And here we go. China 5-year government bond yield. Last time it got this low was 2000, and if you were buying there straight up into 2021, same thing back in 2016 when you had the rip your face rally into 2018, and they've already said they're taking actions on that front and they won't tolerate Eurozone CPI. They're cutting well before the fantasy 2% level. Boy, we got a lot of stuff here, but we're getting down to it. U.S. housing affordability index remains at record lows. Okay, so I think this is going to change, and I think you're going to see a cut or 2 cuts, and all these sidelines projects are going to come rip roaring, and we're going to see a monster amount of supply come back, and that will be good. Okay, so automotive sales. So here's what happened. Came in off the 2020 lows, ripped higher 2021. And that's when, we were at the lows here in May 2022 when we got involved in Cooper Standard at about $5 and change. Started to immediately recover. They got refinanced. Been grinding sideways a little bit for 10 months in this range. And I think this range will ultimately wind up breaking out and recovering over the next couple of years and meeting our targets. Buybacks by corporate clients off of historic highs. So they've been buying back stock like it's going out of business. Now they're in a blackout period. Fed to cut rates 3 times by year end. Lazard market strategist Temple says. Bold call, my man. This is from this week. This guy's calling for 3 cuts. Look, I actually hope he's not right, because if he is right, that implies, as much as I love 3 cuts versus 1 or 2, I think if they move early enough, we're not going to need them. And if we start to need 3 or 4 or 5, I'm a little worried that they missed the boat again and we're too late, and it creates a problem situation. on pace for record low number of stocks beating the S&P 500. We covered that back to 2000. This is the big deal, ladies and gentlemen. This is what the Fed and the Brazilian central banker was berating Lagarde and Powell about over this week's meeting in Sintra, is that the SOFR rates has been spiking overnight. And if you remember, the last time it spiked this time was in October when the Fed finally said, we're done tightening. This was enough to scare them out of their hawkish positioning. And that's when we saw 2 years of gains in 2 months from all the laggards just ripping through the roof in 8 weeks. And here we are. If this doesn't scare them, I don't know what will. And I think they're now paying attention to this overnight rate. Clogged bank balance sheets caused key repo funding rate to spike. SOFR fixed at 540 as of July 1st, according to New York Fed data. Similar moves, similar to funding market pressures seen in late 2023 when the Fed blinked and they said, we're done tightening, and the laggards went bananas in a good way. Reserve balance sheets, reserve balance billion. So this is that facility which is now deteriorating pretty quickly. So they're going to have to pay a close attention to that as well. RRP facility balance. This is what we're talking about. Spiked up here. People clamoring for liquidity. We also saw that late last year. And those are the times when the Fed pays attention. And then the chance of one cut by December is now 95.2%, and the chance of 2 cuts by December is now 68%. Back up. It got down to 61 earlier this week. It's just been silly season, but you can do the math there. Near record momentum tilt. Ladies and gentlemen, you did not want to be in momentum at these previous spikes. And I can assure you this time is no different. On to the news. China announces key reform meeting, emphasizing party leadership. We've been talking about this from July 15th to July 18th. They will have the third plenum meeting where they put out all of their new policy. China aims to be high-level socialist market economy by 2035. And you can see the things that they've accomplished at previous meetings and the timing of those meetings and the impact on the market. This should be a big one, and I think it's going to be a positive catalyst. You can find that article here on Bloomberg by that title. Share repurchase update as of June 30th, 2024 for Alibaba. They bought $5.8 billion of stock in the last quarter. They've got 26 billion still outstanding. So they're getting that cash. They're putting it to work at low levels, which is the opposite of what most CEOs do in America, whereas they buy a ton at pricey levels so they can exercise their options and have a natural buyer. Here in China, they're doing the right thing with Alibaba and buying at low levels. 77 million ADSs to be sure, and they've brought the share count down by about 15% over since September of 2022. That's net of the ESOP plans that they give out stock like candy. They've started to do a better job with that, from 2.6 million down to 2.3 million. This is progress. This is a good thing. And when people start to pay attention to China earnings once again, and they realize that all this means, ladies and gentlemen, is if there's a large pie of pizza, you just got more slices of that pie for no more money out of your pocket. And that's the name of the game. Alibaba reports 26 billion buybacks left. Chinese fintech giant Ant Group spins off database firm Oceanbase, giving Alibaba affiliates a stake. Alibaba to close data centers in Australia, India amid expansion in Southeast Asia and Mexico. That's a gateway to the US. Alibaba's Taobao adds 1 hour delivery shortcut in race against ByteDance and JD. So they're doing what Amazon does here in the US. Surprisingly enough, the Amazon of China is doing what Amazon of US is doing. PBOC vows to satisfy people's housing needs as downturn drags on. So that's probably going to be a major part of the third plenum meeting on the 15th to 18th. And that's really what the market's waiting for, because 70% of people's wealth is in housing, not in stocks. So if they can, create a bottom there, people get more optimism, things will go the right way. And I think they know they've got to do something. China's central bank moves to address bond frenzy. This is a big deal, ladies and gentlemen. That's that chart. Remember that every time they stepped in and those bond yields bottomed, or the bonds bottomed, the stock market ripped. And the fact that they're stepping in and the central bank stepping in, they can turn this thing on a dime when they want to, and that will help our position in BABA. Beijing falls in line with other top Chinese cities to help home buyers. The measures were largely in line with market expectations, so they're taking incremental steps there. We're looking for bigger steps on the 15th to the 18th. Japan will take appropriate action against excessive yen moves, finance minister says. Remember the Asian currency chart I showed you? They are doing this and they will succeed. China's central bank announces treasury bond borrowing to stabilize market yields. Again, taking massive action. We will see massive results. And then this one is just a little bit of a political headline, but worth noting. After the debate, it says Gavin Newsom hailed within China after Biden's debate troubles. Newsom seen as a cool head among anti-China consensus in the U.S. California governor met with Xi on China trip last October. I mean, I have zero value add when it comes to politics. Tune into another channel for that. But I will say that Chinese stocks did exceptionally well under Trump, and poorly under Biden, and energy stocks did exceptionally poorly under Trump and exceptionally well under Biden. And so, effectively you've got a situation where if Trump gets in, probably good for China stocks. If Newsom gets in, probably good for China stocks. If Kamala gets in, I have no idea. And if Biden gets in, it's more that, we know what we're getting, and at some point, price is what you pay, value what you get. It'll catch in, but it's probably the least good outcome as it relates to holding Chinese stocks is if Biden stays in, and I wouldn't make any economic decisions on the basis of a political thing. I just thought this article was interesting. I actually thought they were going to slip this guy in within 48 hours. That was their window. Now they're kind of stuck. But it is what it is. The underground network sneaking Nvidia chips into China. So they're getting one way or another. China leading generative AI patents race, UN report says. So much for that chip embargo. Yen drops to 38-year low. So that's the intervention. And then this article from FT Alphaville is talking about how the Fed needs to measure inflation differently. Why the Fed must change how it targets inflation. And they go into the three errors behind owner's equivalent rent as it's calculated in US CPI and PCE. Quote, and it's the biggest weight. And this is the only thing holding up inflation falling back below 2%. Remember, 70 some odd components, 50% of the 71 components are below 2%. Okay, this is the one that's keeping us above, at the levels that the Fed feels they can't cut, which they're going to have to because the overnight liquidity is going to keep spiking, and the banks are going to keep drawing on that facility, and it's running low. So the problem with OER is that it is a price that no one actually pays, says Paul Donovan, chief economist at UBS Global Wealth Management. He notes three particular problems with how it's estimated. Number one, the U.S. rental market is small. That means small changes in demand for rental property will change market rents, which should be captured in CPI, but these will then be magnified as the rental changes are used to calculate OER. Indeed, the rental equivalent approach is problematic when the cost of home owning, most Americans are on lower locked-in fixed rates or don't have a mortgage, diverges from rents which have soared. Number two, why owner's equivalent rent is erroneous. Quote, the rents used to calculate OER are measured by a survey of just 7,800 housing units, and the response rate has fallen from nearly 70% 10 years ago to 56.5% today. And number three, why owner's equivalent rent is a ridiculous thing that should not be included. Quote, the universe of properties available to rent is unlikely to match the universe of properties available to buy, especially in a specific neighborhood requiring a lot of guesswork. And guesswork is what they are doing, and they need to wake up. So that's that. REITs had a terrible first half. It's time for a turnaround. We agree. Powell talks up progress, putting rate cuts back into view. This is from the Fed whisperer, Timoraos, after the central bank, global coordinated central bank meeting in Sintra, Portugal. So he started to lay the groundwork. That meeting may be, in fact, live. We'll see. May PCE inflation cools after months of stagnation. We know that. Next, Powell cites real progress as central bankers assess inflation fight, again referring to the important meeting in Sintra. And here is an interesting headline that caught my attention. One incredible growth stock down 81%. You'll regret not buying the dip. And guess what that is? PayPal. And they talk about what we talk about with the checkout conversion and the margins reaccelerating and no one wanting it. We love those conditions. Disney's Pixar notches its first billion-dollar film since Barbie in Inside Out 2. My kids saw it. They liked it. Walt Disney numbers raised on Inside Out 2 strength. We love it. Sentiment is changing. Opinion follows trend. Fed's Goolsbee makes the case for rate cut in coming months, citing warning signs of a slowdown. This guy is the voice of reason. It's coming to a theater near you. Stock market's upcoming earnings season may delay overdue pullback for S&P 500, says LPL. We agree. What are they pointing to? That chart about earnings growth for the next 3 quarters off the charts. Susquehanna upgrades PayPal to positive. They put a mid-70s price target, so it's a step in the right direction. And then one of the biggest bears besides Mike Wilson has now left JP Morgan. No one leaves those positions, but you know, he's been bearish since October 2022 when we were pounding the hell on the table to buy stocks like it was going out of style. So maybe we have a short-term consolidation after that. That's usually at or near a point of peak optimism. But Wilson got subordinated 6 months ago and the market's still gone up. So it's just noting these things. They're not like these perfect indicators or anything like that. Article of the week. Cash flow is the name of the game, stock market. So you all saw this article. You probably said, oh, it's 4th of July. He's golfing. No, man. I did golf this morning, 7 a.m. to 10 a.m. Did 2 ball, got done in 3 hours from the blacks. Decent round. Not an 81 again, but it was. But I did play the tips this morning, so it actually brought my index down, pending 12.8. Pretty exciting after 2 years. Anyway, cash flow is the name of the game. I spent the last weekend going through a number of positions as well as other stocks we have covered in past podcast, VideoCast episodes. The conclusion I came to is that we don't own enough of them. I've rarely seen periods where price has lagged a turn or a recovery in the free cash flow to such an extent. Last time I saw anything like this was October 2023. Then we got 2+ years of gains in 2 months. I cover some of the catalysts in the last 2 weeks podcast, 245 and 244. By the way, you can click there. And to that point, I think last week's was one of the best ever. So definitely check that out. I hope people feel that way about this week's, but we're packing them in now. Here are some sample tables to illustrate the point. Free cash flow are the purple bars at the top. Stock price is this green bar here. By the way, go to hedgefundtips.com, click on terms. This is opinion, not advice. We don't know your financial situation. We deal exclusively with accredited investors and qualified institutions, family offices, and the like. So consult with your financial advisor before doing anything. And we'll go from there. Stanley Black & Decker, you can see here, the stock was justified in going down and because of free cash flow here. And now free cash flow has turned positive. And you can see at these points of inflection in the past, you get these periods of consolidation before the stock price starts to reaccelerate. Same thing here. Cash flow went down, consolidated for a while, and then stock price caught up with it. Cash flow down, consolidated for a while, price caught up with it. Ladies and gentlemen, this is not rocket science. You just have to have ice in your veins. That is my unique selling proposition. I have ice in my veins for people who can't have ice in their veins because they're too busy getting rich, building businesses and investing in real estate, that they lay off their stock allocation because stocks have outperformed everything else over the last 200 years, to folks like me, that have the ice in their veins to sit through, buy quality when it's on sale, quality merchandise, whether socks or stocks. And in this case, they hire me to buy stocks. And they know I've got ice in my veins and I've got a valuable special framework that I apply consistently and I don't deviate from, and over time works. So GXO, same story. Their cash flow is accelerating to all-time highs, and the stock price has been in this consolidation period. It's going to catch up. They've got a duopoly, ladies and gentlemen, with DHL. We covered this a few weeks back. I couldn't, it's interesting because, I'm a human being too. As much as I've got ice in my veins, I like to see everything going up all the time. And so when I dispassionately looked at a number of the companies we've talked about on the podcast and a number of the companies that we own, I've never been more excited. Like, what happened in 2020 and then the destock, overstock, destock, and now at the trough and turning point of the restock cycle. Opportunities like this come around once in a career, where you can buy this reaccelerating cash flow when no one's paying attention and the stock price hasn't caught up. And then when it catches up, you get doubles and triples and multi-baggers. And we're going to make a ton of money over the next few years, is my view. And, it's just like, look, you can't drop a ball from the top of a building and the ball goes up. It just doesn't work. There are universal laws that work. Bottom line is, the only reason anyone gives $1 of investment is they expect more money in the back half. And with cash flow, you can't have cash flow consistently growing and the stock price doesn't catch up. It's just a question of when. So if it catches up immediately and incrementally, you'll have linear returns and it will go up with cash flow. And if it's lagged and the stock goes sideways while free cash flow is accelerating, when it catches up, it hockey sticks and it goes straight up. So that's why you have more than one stock. You have, we run a concentrated book of 8 to 12. Why do we do that? Because some of them go faster than we anticipated, and they get to our fully valued status inside a year. Those are the exceptions. The rule is 36 to 48 months. We'd love to hold most of these for 5 years if we can. But this is just unbelievable. Even Disney getting back up to record free cash flow, and the stock is trading like death. I love this stuff, ladies and gentlemen. Diageo, same thing. It troughed just like it did in 2020, just like it did here, consolidates, and then the price catches up to the cash flow. Baba is the greatest example of this in all time. I love this situation. And the same thing happened here in 2015. The stock went nowhere for 2 years while cash flow started to reaccelerate, and then price caught up. Same thing in 2016. You had some choppiness in free cash flow, and then price caught up, parabolic move. And man, we've had unbelievable recovery in free cash flow. Stock has done nothing, and the catch up is going to be so beautiful. I'm very excited. Cooper Standard. This is why we got in. We've talked about, we copied the Charlie Munger trade when he did Tenneco in 2001. He turned 10 million into 80 million, put the 80 million into China. 80 million became $500 million, 2 chess moves, 10 million to $500 million. Well, ladies and gentlemen, here we are. Look at this. We've got our first bar of positive free cash flow, just like we did in 2015. Stock price was just grinding sideways, consolidating while you had negative free cash flow, slowly recovering. This is a cyclical business, ladies and gentlemen. I'm not afraid of those, 5-letter word, cycle. I'm not afraid of that 5-letter word, cycle. This is as cyclical it gets. This is not a buy and hold forever. This is a buy and hold for the cycle. And that's when the stock went from like 30 to 146. You had your first green bar, little choppiness, still sideways. Everyone's like, piece of crap business, blah, blah, blah. And then the stock goes from 30 to 146 as they get to $7 of earnings. And as the cash flow starts to roll back over, the stock is still going up. It takes long as it it works on a lag. As the cash flow turns positive, the price didn't move, and then it works on a lag on the other way. Cash flow is going down and the stock price still keeps going up. Why? Because opinion follows trends, and these are when the lemmings come in that don't pay attention to fundamentals. They pay attention to price. And I can assure you, when this cash flow starts rolling over from these levels, we'll be laying off while everyone is touting the great benefits of Cooper Standard and pretending that they were in it at $5 with us in May of 2022. And we'll just be laughing, sold to you, sold to you, sold to you. Have a nice day. VF Corp, same thing. Look at this spike in free cash flow. You haven't seen this since 2018. And same type of story. You get these troughs in cash flow and then price recovers. Here, crash here. Cash flow recovers, price eventually recovers, and it's just the same thing. Generac, here we go. We've had a huge recovery. Talking in the 70s and 80s. Now it got up to 150. But look, in the scheme of things, the stock hasn't even moved, even though it's almost a double. Cash flow is accelerating to all-time highs. People are asleep at the wheel. This thing is going to continue to recover in coming years. Advanced Auto Parts, another thing like Cooper Standard. You can't give it away. Well, guess what? Cash flow trough, just like it did in 2018. Free cash flow starts to recover, price catches it, and you get doubles and triples. Same thing with Boeing, even Boeing. Okay, so they're going to have negative free cash flow, but they had this same problem in the past. It's a duopoly, ladies and gentlemen. Go try to get a plane anywhere else. Good luck. Baxter, look, if they could shoot them and put them out of their misery, they would. The problem is you can't get a plane for 20 years. So good luck with that. Plus, they employ a lot of people. And remember, the number one job of a politician is to get elected. Baxter International, free cash flow starting to recover. Price is more pronounced. Similar situation in 2016. Similar situation in 2003. The cash flow starts to recover, checks back a little, and then price recovers to all-time highs. Crown Castle, same thing, record cash flow, price is down 50%. This will catch up when you get your first cut or two and people can't get enough REITs. Canada Goose, the cash is recovering like we saw back here in 2020. Cash recovered, price took off. I think a similar situation. Asia sales through the roof. China sales up 60%. Hormel Foods, near record free cash flow. You can't give away the stock. 3M. Remember this, whatever adjusted, spin adjusted in the 60s, now up over 100. Free cash flow recovering yet again. Watch this Goolsby interview on Bloomberg. He's laying the case. Timiraos is backing it up. Powell talks up progress, putting rate cuts back into view. Okay, so we covered the data here. Congratulations to the clients that came in Q1 and Q2. We are now in Q3. We will be opening shortly. If you are interested, this is for the larger accounts, 5 and 10. You can always contact us and come in. The 1 million accounts, we're going to be opening up sometime in early Q3. If you want to get in the queue, I know we've got a bunch of people from the last 6 weeks that are in queue. Send in your interest, and when we open it in coming days or weeks, you will be ahead of the queue and can be able to put money to work right away and take advantage of the situations that we've explained. Industrials, top 30 weights earnings have gone up in the last 60 days, 0.43% for this year, 0.56% for next year. That is in the cyclical bucket we've been talking about. Exploration and production stocks revised a little down for this year, 3%. For next year, up 1%. The only one we have in that bucket is a natural gas company called, Range we've had for many years. We think that continues to go higher, Range Resources. And then Comstock Resources, which is starting to recover, which we love. Okay, so here's the name of the game. Non-farm payrolls tomorrow, ladies and gentlemen. You want to see a number come in below 194. We can't predict it. We can only respond to it. And unemployment rate 4 or above. You get those two things with average hourly earnings. If it comes in at consensus, meaning average hourly earnings are coming down, all is good news, and that gives the Fed power. Okay, podcast over. Now we start Ask Me Anything questions. You're welcome to stay. Jim Jones says, Tom, on Baba Equity, when or if they get the primary list in Hong Kong, does that remove the downside risk Well, one, they are getting it, and two, does that remove the downside risk of delisting from US ADRs? That was solved a year ago. We covered it 100 times on the podcast. The PCAOB has already ruled on that. They're not going to be delisted. Could something change? Look, anything can happen. But, I could also shoot a 66 tomorrow. Would I bet on it? Hell no. Not in a million years. I would bet on me never, ever shooting anything with a 6 handle, ever. Okay? So that would be a similar bet that I would take on this. What's your best case scenario on Baba 5? I've covered that a million times. Go back. Zach Schuler, listening to. Okay, so student at UC San Diego, fascinated by markets, blah, blah, blah. Thanks for this. Thank you for watching. What resources would you prioritize? I think, look, I've gone into it. Go to the Hedge Fund Tips channel and put in University of Bristol interview on YouTube. I explain everything that students should do if they're serious about getting into the business. How do you now screen out companies? There is no screen. You have to have experience, and you get experience by years of reading annual reports, listening to conference calls, and then you have this kind of universe that you've accumulated over the year of good companies, durable moats, good management, and when they get knocked down in price, you start to pay attention. Like Nike, I think Nike probably has more pain before it goes up, but that's one certainly I'm going to be paying attention to. Paul Gertz, I've been listening for 2 years. The recent podcast was... this is it. I've been listening for 2+ years, and this recent podcast was by far one of the best you've done, although they've all been great. It was like a holistic view of every important concept you've ever taught us listeners. I'm very grateful for that, Paul, because honestly, I didn't know if it was too stern. Like, I really went off last week. I hope you found it valuable, and I'm getting a lot of emails like this from Paul that it was the most valuable yet. So check out 245 when you have time. You say you wouldn't have a career without the graciousness of Warren Buffett and Charlie Munger. The same goes for me, but with one further addition is Tom Hayes. Man, that's like, I don't belong in the same sentence as those two, but I'm very grateful for the kind sentiments. Truly thank you for teaching me so much. Just wanted to extend my gratitude and say positively impacted my life. Have a great weekend. Paul, thank you so much. I would not be able to do this without great supporters like yourselves. And also thank my investment management clients who have just done awesome stuff and enables me to come on here and share with the world. Brian McLean, longtime listener, love the podcast. Tell everyone who's remotely interested in investing to listen as well. Thank you. By the way, if you're getting value, the greatest compliment you could pay me is to just recommend it to one friend or family member that you know loves markets, and the podcast will take it from there. I hope to be a client one day. Love your thoughts on VF Corp. We own it. We've been covering that for weeks and weeks. So 2.5-year-old has about a dozen shoes, and they're almost all Vans. As a Bostonian, I agree with the West Coast trend. Is gaining traction here. Just bought myself a pair and was called a cool dad yesterday. Curious your thoughts on Scott's Miracle Grow. It seems to be another company that ordered too much inventory. We've covered this, Scott's Miracle Grow. So the short answer is I like this one. But I liked it. Let me just see where we are. The overweight, the other weight on that was the fact that they got they tried to pitch Wall Street on their weed business, providing fertilizer to grow weed and everything. And like, it just didn't work because they never got the safe banking and all the weed stocks went to zero. Maybe that'll change, but it hasn't changed yet. I like it here. So, that obviously I like you to start to do real research here, but I think it's worth looking at. Nike, Daniel, I just think we're not ready yet. I think that it's been mismanaged for some time, and they rode a free ride on $2,000 checks in COVID, and they haven't innovated, but they'll be back. They like to win. Winners win. That's what they do. So Nike will be no different. And Yeah, I think we're getting close to the point of max pain, but sometimes after these heart attack collapses, it takes a year or two to recover. So I'm all about companies that have already paid the 2 years now and are ready to just gallop like Italian horses. And Nike, I think people are just like, so many institutions had to puke it out because they follow the herd that, let's just say I'm interested in not taking any action as of this second that I'm speaking to you. That could change next second, but it hasn't changed yet. Jack McCarthy, thanks for the great content. Nike, Jack, there you go. You got my answer. Patrick K, thanks for the generosity and enthusiasm. Best video cast in the world, truly 101. All right, so he's asking an election-related question about China. Patrick, I think I covered the possible outcomes. Worst is Biden, but we already know what we're going to get, and it's already priced in the worst case, so you only have upside if you're thinking about politics. But bottom line, price is what you pay, value is what you get. Cash flow is accelerating, multiple is contracting. I love that scenario, and eventually the rubber band stretches back. This time will be no different, regardless of which figurehead is in the office. Tyler Law, just watched you on David Lynn. Okay, so this guy's 38. He day traded following some schmoes, and he's trying to decide whether he should buy the S&P 500 after it's already moved or stay on the sidelines for another few months. You're trying to market time the market, and Tyler, where you're going to wind up with that mindset is you're going to lose the final 9,000 that you have. So what you ought to do is do nothing until you learn what you're doing, or I would say two things. Number one is you're not going to be able to grow any capital with that small amount of capital. So my best suggestion to you is whatever business you're in or profession you're in, take that $9,000 and invest it in education and become more valuable in your primary occupation. Whether that's a business you own, a job that you own, find out what skills will get you to the next level and take that money and invest in those skills. That's going to do far more for you than, buying the next day trading book or whatever you've been doing. And then when you get your earnings power up, then if you're really, really interested, then you start to learn and educate yourself how to buy high quality companies when they're marked down. You start with The Intelligent Investor by Ben Graham. You read that book and you will know in an instant if you are cut out to do this or not. If you're not, then you just need to make a ton of money in your career and lay off that job to someone else. It's just like, it's kind of funny. It's like investing is the only business. Like, I would never outsource heart surgery to some, random person. It's like people who are full-time professionals think that they're going to beat people that spend 24 hours a day, 7 days a week doing this. And it's possible, but it's really not probable. So I would say invest in yourself, become the best as you possibly can at what you do. And if you work at Walmart as a shelf stocker, you need to become the best shelf stocker ever and catch the attention of your manager, who in 2 years promotes you to be a store manager, and you start making a couple $100,000, and then you get some stock, and then you reinvest and you max out your matching 401k. And in 5 or 7 years, you got a couple $1,000,000 and you're 45. And then you take 500,000 of that and you do aggressively, and the rest of you do, passive, normal financial planning stuff and ETFs, and you just grow that 500 to another couple of million over a handful of years, and you retire with 10, 15 million bucks, and you're a shelf stocker. I mean, this is America. Nowhere else in the world can you do the type of things that you can do in America, because it's the greatest country in the world. So that's my best suggestion. Don't try to gamble small amounts into large amounts. Focus on invest in yourself, invest in your own education, and then from that additional value you bring to the marketplace, you'll then have more capital, which will grow more, and you can do that. But in the meantime, you can educate yourself. Intelligent Investor, every Buffett letter, Watch that University of Bristol interview. I go through everything that a person who's interested in the market should do, and you will be no different. But do not gamble with that. You don't know what you're doing yet. That doesn't mean you won't be fantastic in 5 or 10 years. It's just a longer process. Just like any profession, it takes time and there's a tuition to pay. Paul Falcone, Hershey. I think we did do Hershey. It's down on GLPs and down on cocoa prices. Hershey's a great business with a great moat, and I just don't think it's gotten cheap enough for me to get interested. I mean, it's not only that it's not cheap enough, it's just that, like, I usually don't take risk unless it's very damn clear to me I can get at least a double within 3 years, because that's my IRR benchmark for what I like to be focused on delivering. So it doesn't clear that. And I don't see like any catalyst for it to do 75, 80% in the next 12 months. So their cash flows decline, the price has declined. This will recover. I mean, it would have to drop down to like, 150, 140 for me to take a really hard look at it. I mean, if you bought it here and you asked me in 5 or 10 years, is it going to be double? Yeah, but that's not good enough for me. So it just doesn't meet my required return at the current price. Sam R, do you think Trump will be better for China than Biden? I don't care about politics. All I care about is free cash flow. So I can't control the election outcome. It doesn't matter. I know what I got with Biden. I know what I got with Trump. Kamala, I don't know. Gavin, I don't really know. But at the end of the day, as long as no party controls all 3 branches, I'm a happy camper, and I'll leave it at that. Quinton C, Illumina, we've covered this one. This is the icon thing. ILMN. Yeah, it continues to get interesting. I would just say that, like, we own a basket of biotech, which is starting to recover and do nicely finally after a year of dead money. Picking out idiosyncratic situations is not my idea of fun when it comes to biotech. I have no edge on when their drugs are going to get approved. I mean, their cash flow is recovering. The price is hammered. I think their margins are still going down. I think they had, if I remember, it was like diagnostic tests or something. So this might be a little different. Sequencing and array-based solutions for genetic and genomic analysis. I just have no edge here, so I'll leave that one to Carl Icahn. I mean, it's a business I can't understand, so therefore it goes in my too hard list. Kate Kilroy, thanks for the amazing content you provide every week. Question regarding Alibaba. Okay, this is a good one. I have a question regarding the Alibaba position in the stock repurchase program. Last 1 year, management's repurchased $15 billion, which is almost 10% of the common shares, but the stock didn't even go up by 10% from the average price it was repurchased at, stayed the same, more or less. How come? Great question. I think a lot of new people won't understand this. So what happened when they bought in 10% of the stock? You gained 10%. Your slices of the pizza pie got 10% bigger. So you got more bites of pizza for the same amount of money. The question is, why didn't the stock price reflect it? And the answer is, sooner or later, it always does. That's the beauty of public markets and why I rarely do private deals, is because you never get an opportunity to buy such great large slices of pizza for small amounts of money in private markets and public markets. If I was ever to talk about buying Alibaba at 8 times forward earnings, when the greatest businesses in the world, cheapest AI play in the world, most optionality, cloud business, Freshippo business, Taobao, Tmall, billions of people, all these exciting things, company coming out of a once in 100-year event at 8 times. If I walked into their boardroom and said, look, I've just got financing for $500 billion from JP Morgan, I want to take you private at 13 times earnings, they would say, call security, the guy is mentally delusional. And that's one of my filters, okay? When I look at companies, if I raise capital to buy the entire company at the price it is quoted in the market today, would the board be insulted and have me escorted off the premises? The answer must be yes. So in the short term, the market is a voting machine based on emotions. In the long term, it's a weighing machine based on fundamentals. To answer your question, Kate, the stock price didn't go up on your timeline. In other words, you expect if I hit the wall, my hand is going to hurt immediately. With stock prices, actions are taken and there are massively delayed responses, whether it's cash flow recovery, cash flow declines. Remember that picture of CPS where I showed you cash was declining, free cash flow was declining from 2016, 2017, and everyone was still bidding the stock up from 100 to 146. And then once everyone realized and all the lemmings were in, it collapsed. And the similar is true with Baba. Everyone's puking while cash flow has recovered. And when it flips on a dime and you wind up with multi-baggers. And people just don't have the ice in their veins. It's not human nature. I'm abnormally wired to do this business well because there are just not many things I can do well. And this happens to be one of them. So it is what it is, blessing or curse. I love it. And ice in your veins cannot be taught. So you just hang in there. If you've done your work and if you do your analysis, eventually that bigger slice of pizza is going to be so big because they've bought out all the other slices that you're going to have a feast. And so right now you're starving. And 12 months from now, 18 months now, we're all going to have a monster feast. And the sad part about it is many of the people listening to this podcast today are going to miss that feast. They're going to throw out their slice in the trash at the exact wrong time. And when we're all having a party and our massive big slices, not only will they have missed it, they're going to be really angry that our party was so big. So it is what it is. And finally, Jack Greenberg, did you do any work on Jacobs QXO? I covered this a couple weeks ago. I did work. I'm not ready to do anything on it. I'm plenty happy with GXO. So with that said, I want to thank everyone for tuning in. We'll be back next week, same time, same place. If you thought I was taking a break on 4th of July, you thought wrong. We went at it today, and I hope you enjoyed it. We'll see you next week. Bye for now.